All right. Good morning, everybody. Good morning to you, John Walkup. How are you doing today?
Hey, I'm doing all right. I am down in Baltimore visiting some family. So
All
on it
right.
to Macro Monday from the road today.
Road-driven Macro Monday. I
Road trip
love it.
edition.
I love it, guys. Well, it is Monday, so you know what that means. You guys are going to get a little bit of Macro Monday coming right at you. That is John Walkup. I'm Noah Rosenblatt. We're both of UrbanDigs. For those of you that are new to this show, we're going to start out with Manhattan real estate, go over a couple of key topics real quick, and then we're going to go into a bunch of these macro tabs, charts, tables, data, whole bunch of macro things. Hopefully we will not confuse you guys. And then we will circle back to Manhattan real estate at the end. And we will try to do this all in 30 minutes or less. If you guys have questions, please do not hesitate. We are on a bit of a delay, but I think you have a live chat there, right there on YouTube live stream. Go ahead and put that in there. John, you got to keep an eye on that, right? One job to do.
It's my job. Yeah. So I'm keeping an eye on it. And I also realized like I can click one of the chats, and I'm glad you brought that up because now
There
I
you go.
remember you can actually click it and I can display it. So
There you
that'll
go.
be fun. Hopefully we can have some good chat today.
Ask your questions, guys. We want to hear about it. And let's get right to it, guys. Let's get right to it. I don't want to waste any more time. I'm going to scroll down to the market snapshot. We like to do this in the beginning of Macro Mondays every week. We're looking at Manhattan. We're looking at 1 month trends. I want to start with supply first. Over the last 30 days, we've had about 1,518 units come on the market now. For June, the average is 1,386. But this thing is falling apace, and it's very possible that in another 2.5, 3 weeks, this is going to be at or below that 1386 level. So that's in the process of doing June things, Johnny. Declining listing activity.
Yeah, and that's one of the things that we talk about on the weeklies when we do the weekly reports, which I hope you guys all watch on the come out on Fridays. Same thing in Brooklyn. Very seasonal. I mean, you look at the last couple of years, I mean, they are basically right in line with each other. So supply, I mean, we've talked about the story of supply. There really hasn't been a story. The question now flips to contract signs. That's sort of where the story of supply might be written, is in that demand or lack of.
Yeah, supply was actually doing okay for the last couple of months, right? We've had more listings coming on the market over the last few months than typically average, and it gave us some options. But you're right, contract activity is what we are all about here at UD. When I look at the 30-day pace of contract signed, I see 904. Mondays are always the lowest. We didn't pick Macro Monday for a good day in terms of this metric.
No.
We got a lot of weekends in there, but we're supposed to end the month at 1,055, and the story really for the last couple of months is that you had more supply coming on and you had lower demand. So more supply, lower demand, the market pulse is going to shift down. This is basically the Liberation Day shift that we've had. I do not see evidence in either the market pulse right here or liquidity deal activity here that's telling me that we're rebounding from this, Johnny. Looks like we're just kind of fading from this new lower place.
Yeah, and I think part of the conversation we were having toward the end of April and even into early May is, are we going to see a May bump? I mean, we definitely had a bit of a shift down. Is the spring going to recover back to some of the highs that we saw in early March? The answer is no, it didn't. It just went to that lower level, stayed at that lower level, at least for Manhattan.
Yeah. So you got to let your clients know what's going on with this market. I mean, we told you guys that the spring season, pretty much first couple of weeks of June is your last kind of hurrah. Third week of June, fourth week of June tends to be slower than the first 2 weeks. So if the market's shifting ahead of us right here, you need to let your clients know they need to make price amendments, do what they got to do to get ahead of the market. Just keep that in the back of your head. It's a little tougher out there than we would hope for this time of year. Okay.
Yeah,
Any questions?
The one. Well, I just think the one silver lining I would say is that if you look at the Brooklyn market, so seeing the same sort of metrics happening in supply, but that contract sign number really didn't see the same shift down. It didn't quite rise to the same level as it did in Manhattan, but essentially Brooklyn liquidity, in a sense, has been moving sideways, which is kind of interesting. And we talked about this again on the weeklies, the idea that there's a lot of adversity out there, and that supply at that liquidity level, even with the challenges, moving sideways could set Brooklyn up for something interesting, maybe another run in the summer, fall, not sure, but that's at least something to keep an eye on.
Yeah, it looks like over the last couple of months, this whole shift of Manhattan, Brooklyn's doing, pretty strong, relatively strong and resilient in the Brooklyn market, considering not a seller's market, not a high liquidity market, but relatively strong considering, I guess. Interesting. All right, let's shift, John, unless there's any questions.
No, I am watching the chat like a hawk, and I don't see anything.
All right, guys, let's pivot to the macro portion of the program, guys. We're going to start with credit spreads. Do not get scared by the phrase credit spreads, guys. This is simply our canary in the coal mine type of guide to let us know if the credit markets, if there's stress that's rising or stress that's easing, that might create a risk on environment where money is chasing yield and stocks are going higher and there's euphoria and buyers of Manhattan real estate are bidding more aggressively. And then there's risk off environments where stocks are going down, and again, it has a negative effect on Manhattan real estate usually. When I'd like to take a look at credit spreads, it's reverse, guys. As it goes up, it's bad. As it goes down, it's good. Okay. Credit spreads have eased. They have come in. This is the whole. Let me go to 6 months right here. Okay. This is the whole April thing. Okay, that whole move right over there is a whole April thing. Since that whole thing, since early April, that was our peak fear, by the way, early April. This has come down to a much better level. We're still above kind of where we were before, but this has eased. So credit spreads have been doing okay, Johnny. And I guess stocks at record highs are kind of reflecting that. But I feel like Manhattan has not had a comparable bounce or recovery.
Yeah, I think it's interesting. So if you zoom out, maybe you look at like a year or so on the credit spreads, you can kind of see how they were lower last fall. They've really they rose, I suppose, into April, have fallen since then. But again, you think about what happened in the stock market, right? We had a big drawdown and then a recovery. I mean, we're up what? I think the market's in general up about 20% since its lows. So you've seen the stock market recover pretty much everything it lost, if not more, since that time. However, credit spreads haven't gotten back down to that level. So
yeah,
the idea is I think there still is that heightened sense of risk. If it's not necessarily manifest right now, I think credit spreads are pricing in an anticipation of there may be more risk to come. So I still remain biased that this could increase rather than decrease in the near term.
I'm kind of I'm going to go against you, Johnny, on this one. I think I did last week as well. This trend that I'm seeing down and sideways is okay. We could just stay at this level and we could be okay, kind of thing. And I just want to reiterate, when you hit max on this chart and you take a look at kind of where we are now, I know it's hard to see on the right there. You see the pandemic spike, you see the great financial crisis spike. We're just nowhere near those type of levels. So I don't know, like what's the trigger going to be? I don't know, higher rates, some kind of geopolitical thing. I don't know. But for me right now, credit spreads are just doing a whole bunch of nothing, which to me is a lot better than wherever it was a month and a half.
Yeah, well, I think in terms of the broader economic signal that these represent, they're not signaling any sort of emergency.
Correct.
Sort of, you really should button up. Like, we're not seeing
Right.
that. I just generally think that the way things are right now, I think things will become money will become more expensive. I think rates and the risk will rise more to the point because I think there's just more uncertainty. So that's why I'm biased to the upside. So
well,
yes, they're ticking down, and yes, I think that the fear of early April has lessened, and I think you're seeing that. But I still think it's very palpable. It remains out there. Just something to watch as we go forward.
Well, rates have gone up though, Johnny. Like, that's the thing. Rates have gone up while this credit spreads have kind of narrowed and come down. When we'll get to that in a second. I mean, it could rates go higher and this come in at the same time? Or does it necessarily have to mean higher rates equals uncertainty and volatility?
Yes, well, I think that's my point. Is that I think we're starting to get into this point where we're considering, and we're going to get to this in a second, looking at what the Fed's doing, and the idea is that we're starting to pencil in more and more, maybe not rate cuts per se in terms of the blue. Oh, there is the blue boxes, but the number of white boxes to the far left is starting to increase. So I think we're starting to get more thought space. I don't know what that word is. That the idea that rates are going to be lower, at least the short-term rates are going to be lower toward the year end or next year. But I wonder what that does to the longer term stuff, right? The 30-year, the 10-year, the 30-year. I think that could sort of, as these fall, I don't think they're going to be falling on good news, right? You had the economic reports last week with the payrolls that were not particularly great. That does boost the case for a rate cut. But at the same time, it could also boost the case for higher rates on the longer end. And that could mean higher mortgage rates. So that's what makes me a little bit concerned about where I see credit spreads right now.
Yeah. Did you catch Jamie Dimon's piece that he came out with? He was on a panel and he was talking about the bond market. Did you happen to catch that?
I heard about it. No, I did not. I was on.
I wanted to get a snippet and put it up here for you guys to see. Maybe that'll do it next week. Basically, he said the bond market's going to break, and if the bond market breaks, that means rates are going higher. And he said it's not a matter of if, but when. It's as if he knows something. But the 10-year yield's at 4.5%. It's yet to get over that 5% level. But it's interesting to see that, again, this cycle, it looks like government bonds could be like where the bubble is and where the pain really comes, and then that trickles into the rest of the economy, where it's not housing, it's not, maybe it's crypto, I don't know, but it could be fiscal deficits. That's the problem that we have to deal with in the near future. So
I think that's a great point. It comes down to deficit spending. It comes down to what does the balance sheet look like? And I think this is not even a macro problem. This is also a micro problem. Right? And this is something that New York City is going to have to deal with. It. We have a mayoral primary coming up in 2 weeks. So that's really close.
Yep.
All of these things are front and center, but they're sort of on the back burner because of, the things that catch people's attention in the news is not necessarily deficits right now. It's other things. It's what's happening in LA. It's all this sort of stuff. And factual, sensible talk about whether or not the budget can be sustained has sort of been pushed to the back burner. And I think the bond market is the only people paying attention right now.
Okay. Well, we got to keep an eye because the bond market feels pain. That means higher rates. If we have higher rates, that could potentially impact our market. But again, that's going to put us into a situation where 65% cash market, it's going to be the 2 million and under market that really gets hit with that kind of thing. It's
exactly right.
A lot of cash deals out there. Let's pivot to Fed, guys. This is the Fed fund futures. This is what we look at in terms of what the market expects in terms of rate cuts, lack thereof, or rate hikes. What you need to know is we are there, and I don't see anything on this side of the ledger here, right? So there's nothing on the right, which means rate hikes are not being considered by the market right now. There are rate cuts considered by the market, and let's go over that really quick. To the left, you have your meeting dates for the next 2 meetings. That takes us into June and July. I don't see any moves at all. We got a pause, 99.9% chance in June. We got a pause, 85% chance in July. Then I see this shift right over there. That is a 1/4 point cut. When is it? September 17th. Does that mean it's going to happen? No. But that is what the market is expecting, 53% chance. There's also a 38% chance they don't do anything, right? So when you talk to clients about this, again, we'll tell you about that. Talk to clients, tell them what the markets are expecting. Let me just go through this really quick, and then I'll tell you what that line is, okay? October, no cut. Pause right over there. December, you still got your cut, 40%. So as far as I'm concerned, I'm going to stop right there because who the hell knows what's going to happen after December? We don't even know what's going to happen in 3 months, let alone 6 months, 9 months, 12 months down the road. What I see here is 2 rate cuts, one in September, one in December, both of which at best are like a coin flip. And the December one's even significantly lower than a coin flip. So if you talk to clients, this is what you want to say. According to the Fed fund futures, which is what we're looking at here, the markets are expecting 2 cuts, one in September, one in December. But even those 2 cuts are questionable and may not happen. May have 1 cut. That's what's going on right here, John. What do you see?
I mean, I don't even stop commentating on this because I feel like I've been wondering why we're not seeing rate hikes on the other column. Given everything that's going on, it sort of made sense to me. But I think the market is fully in cut mode. I think the weak economic data that came out, again, I mentioned earlier, the jobs report was a little sad. So that was on Friday. So that kind of gives you a little bit more ammunition on the cut side. So, all right, I'm going to give up thinking that maybe there's some people out there who are going to see hikes. I think it's on the cut side, but again, I talked about earlier about the preponderance of white boxes on the left, which things are, but the blue boxes aren't really shifting. So because of that, we like to think about the movement in blue boxes and how those shift, right? That's sort of the aggregate cuts in terms of where that percentage lines up, how that might shape mortgage rates. But just because you're seeing the cuts, you're not seeing it in mortgage rates. In fact, the jumbo was sharply higher last week. So you're getting into some dicey territory here. Yeah.
So I have this, which was 2 days ago that I wanted to show you guys. 30-year jumbo just below 7%, and it kind of shows you what I like is this 52-week range little thing right here. It kind of shows you where we are in the 1 year range. We're kind of a little bit to the right of center over here. So that's kind of where we are, and then you get this chart which we've been showing you guys, and take a look at that lighter blue line. And this may have had an update before that other table. So I don't know what this is, but did rates spike over the last 3 days or 4 days over here? I mean, according to this, you're over 7% in terms of jumbos right now.
Yeah. Well, look, I think everything kind of comes down to the property and what the buyer's portfolio looks like and
all
the
that
loan to
stuff.
value. Yeah, totally. I just generally like, and bear in mind the jumbo rates are much more spiky, so you're going to get those big moves. However, the fact that it just happened, given the context of everything we're talking about, sort of makes me wonder, like, all right, well, are rates going to start heading higher again? And one of the things I like to look at, my own little indicator, is when you see that jumbo line really close to the conforming line, that's when you kind of get a sense for, all right, there's a little pressure on rates. Some of that, risk premium could be taken out. You could see rates go down. But when you see that jumbo rate spike like that, and you think about the risk, with the absence, I suppose, of risk premium out there in the market right now, as evidenced by credit rates and the idea there's a Fed cut coming, I get the sense we could start seeing actually some pressure to the upside in mortgage rates, which, I'm not really wanting to have happen.
Yeah, I feel like the mortgage market is pricing in potential for less cuts. That's what I feel like. I don't know why. I just feel like that's the case. That maybe we won't even get those 2 cuts. That there's more of a wait. There's gonna be more of a wait and see attitude with the Fed as time goes on.
Yeah, I think we're just I've talked about it earlier, that sort of fulcrum point. So that 10 years right in that fulcrum between the short term and the long term. And I think right now it's that long term. Even as the short term goes down, I think the long term is poised to go even higher, which would argue for a higher mortgage rate, since that's sort of that middle point. And I want to put this on pause for a second, because there's a really interesting conversation happening in the chat about co-op price floors and whether or not, what happens when a co-op basically rejects a sale because the price is quote unquote too low. So, if you're not paying attention to us, pay attention to that, because that's pretty interesting too.
Yeah. All right. Well, go back to November on this chart, guys. Go back to November. It's right in the middle here. I feel like we're in a channel. There's a top channel. There's a bottom channel since November, and we're kind of at the top end of it. I feel like rates have been kind of in between, like I'm the jumbo, the light blue line, kind of in between like 6.75 or just below that to like 7.25 or just below that. We've been in that channel for a long time, and we're just kind of approaching the top end of that channel. I don't know. Do we break it? I don't know. So 7.25, we start getting above that, then we're starting to get into a new potential level. Otherwise, I would expect this to ease a little bit and just remain in the channel, and we just happen to catch it on an uptrend. So we'll keep an eye on that, but rates have been ticking higher. Okay. You talked about the jobs report, John. You mentioned there is some little bit of weakness in the jobs report on a week-to-week basis, but you know what? The unemployment rate right now, it's just low, guys. It's just low, 4.2%, something along those levels. And we found this nice little chart that kind of visually tells a story that you could see this bottom blue line, historically low level. Like, we've been in the historically low level unemployment period for a while now, and we're just about to touch the threshold of the historically normal level at the bottom end. So it's like, I don't know what we see here. Yes, it's going up, but at the same time, there's nothing crazy critical here that would make the Fed step in and be like, oh my God, I got to cut rates. This would have to go a lot higher for that to happen, John.
Well, yes, and that's why I think, and I mentioned the idea that Friday's jobs report sort of underscored the idea that you could start to see more rate cuts instead of the possibility of rate hikes, which I think I might be the only one arguing for that. However, the blue boxes didn't really move, right? You have a lot of white boxes. You have a lot of people thinking rate cuts coming, but the market itself is remaining pretty solid that we're not going to see that if or few cuts coming up. So I think, to your point, that's what you're seeing here. The other is, there's some inside baseball going on around the analysts and the people who really dig into the data, saying, all right, well, given the backdrop that a lot of people are now leaving the country, that actually shrinks the denominator, which actually means that the unemployment rate itself, the mathematics are going to change, because now you have basically a smaller unemployment rate per population, because the population kind of shrank a little bit. So there's some inside baseball trying to understand the new understanding of what this metric, how to interpret this metric, given the political backdrop that it's being set in.
Okay, well, we'll keep an eye on that. Thank you, John. Now let's move over to the housing portion of the program. Let's get away from macro. I'm going to get too in the weeds over there. We get a little confused. I want to go to the national housing market. I like to stick in a couple of national housing market charts every once in a while, just to get a sense of where we are relative to the world around us. And I can't get over this chart. I just can't get over. I know I showed it to you guys a few weeks ago, I think. But
yeah,
look, active housing inventory available for sale right now. All right, well, this was May 2025, I guess a week ago. Compared to May 2019, pre-pandemic, where were we? Where are we now? Brown is negative. I mean, that's minus 50%. Brown's minus 50%, and that blue is plus 50%. So you got a big range there. Look at the disparity, John. It's just like, what's going on with Illinois? Look at the Northeast. Like, it's crazy.
Yeah. Illinois Illinois stands out because it's like the entire state is low, right? New York too, New Jersey. These are like, I'm going to use the word because it's the color. They're brown states, right? They're in terms of Lance's color code nation, they are low. I mean, Alaska, don't sleep on Alaska down there. Also low. West Virginia. So I don't know what's happening there, but it's definitely the Northeast. I mean, again, Alaska, but again, Northeast, low inventory. The South, Southwest, higher inventories. And we've been talking about this for the last, I don't know, it's almost like a year or so. I think we've been talking about the shift that we've seen.
I'm waiting for it to change. Like, I'm like, it's not changing. It's getting like going the other way. It's getting even lower. Like, it's just, it's kind of crazy. And you think about where we are in this whole thing, and you think about a housing cycle, and it's going to look different. It's going to look different for these reasons, for these structural reasons. Guys, take a screenshot of this. If you ever get into a client conversation, why invest in New York? Why? This is one of the reasons, right? If there's a bubble to be bursted, it's not in housing, and if it's in housing, it's not in our market. That's for sure. So interesting stuff right over there, I thought. And then finally, again, for a national level, you think higher rates, and you think of inventory shortages. The first thing that comes to mind is lock-in, right? Lock-in effect. Who the hell is going to leave an apartment? 3% rate, 3.5% rate. When rates are 7% now, they're not going to leave. They're trapped in the thing, and that's part of what's going on. Take a look at the black bars, guys. The black bars on this chart. That is national new listings by month. And if you just go back, the last, you have to go all the way back to last September. To the gold in September of last year. It's just been on an uptrend, and it keeps getting more and more and more and more. You don't see it here, but this is what's happening on the outside. So they're questioning, is the lock-in effect easing? Is this natural time eroding the lock-in effect?
Slowly? Yeah, well, I think if we look back to the mortgage chart, right, and we think about the jumbo sort of at the top end of the channel, as you were saying, and potentially going higher, is what I'm saying, is that that lock-in effect could remain here for a longer time, especially when you consider the rental backdrop. So if you're a renter and you look around at market rents, and market rents are, far above what you're paying, right? You're not really going to move. You're not necessarily going to jump in the sales market because you can't afford it either. So a lot of folks are just staying put. That puts a lot of pressure on existing inventory, which is just not being satiated yet.
Yeah, it's just crazy how disparate, how regional this housing market is across the country. It's just such a different thing. All right, well, we didn't have macro charts for the day. Let's circle back to Manhattan, guys. This is where if you have your last chance to ask any questions, John. I don't know if you see any questions for us out there, or if everyone's just talking amongst themselves for Klempt and everything. I'm old when I say that.
There's a really great chat. Hang on, I wasn't really paying attention, but there was a good chat, a good conversation about co-op price floors. So I think people chimed into that. I think it's great.
Okay.
Talking about some unemployment stuff. Are there really enough people leaving the country to impact the unemployment data? I'm not sure. I think that was sort of the topic of conversation in terms of like understanding how these numbers might change the numerator or the denominator of the fractions they use, whether or not that actually adds up to anything. I'm not sure, but it's interesting that that's sort of the conversation. Hasn't the profile of workers changed since the pandemic, meaning the employment numbers are really they don't really tell the full story with the gig employment, people dropping out of the jobs market? Yeah, I think that's a great point. And it's
great point.
I think it's a great point. And that's, we saw that in the housing market too, right? The idea of, the pandemic was sell New York City, buy rural, buy suburban, because you can work from home, work from anywhere. Maybe seeing a little bit of a reversal now, but again, it's not set in stone yet that the cities are 100% back.
Yeah, and you bring up cities, you bring up international visitor tourism and stuff like that. And John, you sent me this very interesting chart. It's outside of Honolulu. Okay, we'll put Honolulu in its own category. Some of the cities across the U.S., they're down. Look at New York, up 1%.
I thought this was interesting. This is a long article about how over the last year or so, tourism to the U.S. has really taken a hit, especially since January. It's down in a lot of places. right? And for whatever reason, the idea is that you see these drops, except for New York. Well, Honolulu, okay. I'll argue this. I'd rather go to Honolulu than New York if I'm a tourist. But hey, that's just me probably because I live in New York. But that being said, I think the 1% gain in New York, so that year over year, it's not fantastic. But the fact that New York's able to hold on to the visitors when a lot of these other cities are seeing drops, in some cases precarious drops, to me speaks to the idea that there's something bubbling under the surface, that the city is sort of, it's dynamic. And I think people recognize that. And I think there's something about being in this city that you can't get anywhere else. And I think that's one of the reasons why our real estate market is doing so well compared to some of these other markets.
Yeah, I mean, it's we can't forget this volume trap that the market's in. I looked at pending sales across the nation. It's still at like low levels, very, very low levels. They really haven't bounced back at all. We bounced back, but like, we're starting to fade now from it. I mean, isn't this like Noah Newman's thesis? You know what I'm saying? Noam Newman's thesis, right? I mean, that New York it's a sleeping giant that is about to awaken. It's been asleep for a decade, and it's about to awaken. He pins us back to the sales market. He pins us back to 2010, right? Which, think about 2010, 2011, wasn't great for the sales market. But 12, 13, 14, 15, that's what he thinks we are. He thinks another year or two. He's going to start with rents. And you look at the rental market right now, you look at the commercial sector right now, it feels like there's a little bit of an awakening and a little bit of an activity going on in those sectors. Does that portend the sales sector? Again, not now, but later. And this is an interesting thing, part of the narrative.
Yeah, this is just one little piece of that narrative, right? And I think it's an important one, but it's all these little pieces kind of add up to the idea that New York City is quietly undergoing a resurgence, which I am hoping becomes a lot more manifest in the future.
Suppressed, John. I'm going to stick by my thing. I think it's a suppressed market between demographic change, between policies and all that kind of thing. The pandemic, Jesus Christ, three big things. We have been suppressed for a decade while outside markets have not been suppressed, and their markets did the appropriate thing.
But a lot of it's, I have to say, a lot of it's a bit of an own goal too. I think New York City could have done some better things in the past in terms of, the run up to COVID, post COVID. I think there are some policy changes that perhaps New York could have done a better job with. I don't necessarily want to drag that in right now, but yes.
I got the Fair Act thing going up soon. I think there's like a battle going on there. We don't even know if it's going to happen. Actually,
well, thank you for introducing that. So Jeff writes in, basically says we're waiting on the new rental laws for June 11th, and if the owners are required to pay the fees, that could be passed along to consumer. That might actually shift some renters into the buyer pool. So there's a lot of stuff happening out there, man. It's just you got to pay attention. Sometimes you just got to stay in your lane and focus on what's right there because there's a lot happening.
Yeah, I don't understand this whole Fair Act and how they don't consider the unintended consequence of that kind of stuff. It just doesn't. I don't understand it. It's very, very clear. I don't get it.
Well, I think that's generally my point when I talk about New York City and some of the regulations it's got. There's a lot of unintended consequences that come around to bite you in the butt, like 3 to 5, 6 years down the line. It's like, oh, it wasn't the best idea.
Yeah. So, well, all right. Well, let's circle back to this right here. I got a couple of charts that maybe you guys will find use out of here. John, we did this on Friday. And I just want to bring it up over here and talk about it just a little bit. Asking price decay over time, guys. This is something we all know, right? We all know, we live it, but your clients may not know. And there's a sell side discussion here, and there's a buy side discussion here. If you know how to extract this chart on the sell side, take a look at the left side, guys. Your chance of getting 100% of your asking price diminishes greatly in the first 30 to 45 days. Well, not greatly, it's not a lot, but I mean, on a percentage basis, 3, 4, 5, 6%, that matters to some people. And then it gets really kind of scary as you go further and further out in time. On the buy side, if you want to get a deal, you want to get some value, you want to put a low ball in, you're looking not so much for a specific unique type of property, but you're looking for a good play. Do a search by days on market. You can do that on UrbanDigs in our advanced search. Just do a search by days on market and locate all those properties that are 170, 180 days plus on the market and see what's going on with them. Maybe there's a play there. What do you think, John?
Well, yes to all of that. I also want to say this. So this chart uses about 10 years of data. So I'm back to 2015. So we've got tons of data in there. Look at Brooklyn. And what's interesting is in the first, within 14 days, it's actually over ask, which I mean, that's phenomenal. And I think that really speaks to that borough's resurgence. And we talked about sort of at the very beginning, everything's kind of been quiet. Brooklyn is still quiet, but it's going sideways at a time when Manhattan is starting to, roll over a little bit, which, could be interesting as summer comes in and then eventually fall.
Yeah. And guys, again, you take a screenshot of this, do whatever you got to do. I don't care. This is Manhattan by condo, co-op, townhouse. Just in case you have a co-op or a condo or townhouse and you want to specify it a little bit. Clearly, condos and co-ops are kind of the similar. Looks like co-ops are outperforming in the front half a little bit, but then underperforming in the latter half. And it looks like townhouses are just on a different level altogether, which makes sense. Obviously, those are much more illiquid than co-ops and condos. So thank you, John, for bringing up these charts. Hopefully, people that are watching find some use out of it.
I hope so.
All right. I think we've reached the end of this whole program here. We've given you guys enough. Is there any final questions here, guys, or no? We good?
Someone asked, is the chart in the chart room? Can we do this by area, type of property? No, this is a special one that we did.
Specialty.
I was digging in. If you're a subscriber, feel reach out to us. Noah at UrbanDigs, John at UrbanDigs, because we like to share. Sharing is caring.
Yeah, you guys can email us. We'll share the chart with you guys. Tomorrow, if you happen to be around, 11 o'clock for 30 minutes. That's all these things are, 30 minutes. We will talk about the property pricing wizard tool that is right over here, guys. That is a CMA. That is a comps. That is a building analysis tool all in one. If you ever want to learn how to use that tool, we'll talk about it tomorrow at 11 o'clock. Other than that, John, we're going to wrap this up.
Almost. People would like to take screenshots of the charts.
All right, let me go back.
Let's do that.
Screenshot time.
Just a second, people.
Oh, I can't time it. I can't do a countdown because we're delayed.
Yeah, that's true. Okay, so here's the first one. There's another one, right? Where's the Manhattan Brooklyn one? So
I'm putting up both of them. I'm putting up both of them. You can take your screenshots.
Nice. They wrote in. Got it. Thanks. All right, you're welcome. Thank you, everybody.
This 20-second delay is not easy, I got to tell you. This has been fun, guys. I hope you guys got a couple actionable takeaways over here on what's going on with the rates, what the market thinks anyway. Credit spreads seem okay right now. Mortgage rates ticking on their highs, and again, we're having a fade to our spring season. So please act accordingly. Tell your clients what they need to know. And John, thank you for helping me whip up all these charts. That is John Walkup. I'm Noah Rosenblatt. We are with UrbanDigs, and this has been Macro Monday. Hopefully, I'll see you guys tomorrow.
See you next time.
Take it easy, everyone.